My name is Elizabeth Gamble. Up until not too long ago, I was Elizabeth Shirt. I hadn't intended to hang on to the shirt part of my name, but it turns out my initials are ESG. And so it's really interesting times for that because, you know, ESG is dead, long live ESG. I try not to take it personally, but there you go. I have the privilege of serving in the role of CEO of a group of organizations called Profoundry. That includes Delphi, Globe, Canadian Business for Social Responsibility, and Leading Change Canada. And we are here today with this group of incredible experts to talk about how sustainability is moving and shaking up markets. And I promised Gary in our prep call I would dance on stage. So we are moving and shaking markets up here today. Right? Are we? Yes. Woo. Heck yeah, we are. So I'm joined on stage by these three incredible leaders and experts in this space. Abdullah Chowdhury, founder of Arbor, a data science platform that helps companies measure, improve, and showcase the sustainability of their products. They have a booth in the back. Make sure you stop by. Ray Tayabi, Executive Director of Client Coverage for MSCI, where he leads sustainability relationships with corporates, banks, and asset managers across Canada, always with the goal of providing analytics to help investors link sustainability with financial performance. And last, but very not least, capping us off on the end, Ariane Bourassa, Head of Sustainability and ESG Strategy at TMX Group, the owner and operator of the Toronto Stock Exchange. So I'm very aware we are the last thing between you and a drink and a chance to do some networking, which is a dangerous place to be. So we're going to keep this engaging, impactful, and most importantly, on time. And we do have a little clock here to help us with that. It's getting late in the day, so I did want to start out with a little bit of an audience engagement exercise. I'm going to ask a question that has a one-word answer, and I'm going to invite folks to just throw up your hand or even call out the answer if you're really feeling brave. One word. How would you describe how you're feeling about the state of corporate sustainability in this moment? One word. Who's brave? One word. How are you feeling? Scared? It's all anonymous. Anybody? Uneducated. Anybody else want to play? Uncertain. Hopeful. Cautious. Anybody on this side of the room want to play? No one's going to know it was you that said it. Optimistic. Yes. All right. Well, so like I said, thank you for those of you who jumped into play. We're here to talk about how sustainability is moving, shaking, and shaping markets. We're going to do it using real data, examples of real companies and investors here in Canada and globally. For some of you who might be feeling less optimistic, hopefully we're going to send you to networking with your glass half full. Okay. So real quick, our panel thesis, and we've heard some of this already. Too often, sustainability is framed as a compliance exercise about rules or reporting, when the real story is about the opportunity to go from that place to competitiveness and value creation. And in fact, early momentum and action on corporate responsibility was actually anchored in that belief. In recent years, though, the narrative has really shifted to a focus on disclosure and regulation as the end game, rather than that opportunity for value creation and long-term returns. Of course, we know current economic uncertainty, political upheaval is driving business leaders to really hone in on the core business. There is no more room for nice-to-haves. So what does that mean for sustainability? Well, it means we're coming full circle back to a place of materiality, returns, and impact. And the fact remains that when done well, there is a tangible sustainability ROI, and that is what we're going to talk about today. Now, despite some criticism, the 2025 federal budget does maintain some of the building blocks that we need here in Canada to leverage that return. Carbon price signal for industry, commitment to a Canadian sustainable finance taxonomy, amendments to C-59, which despite having laudable outcomes, proved to be problematic, dedicated funds for climate upskilling, and a clear priority placed on helping Canadian companies access new markets, Europe, Asia, emerging. So with that as context, it's enough from me. The group of experts you see on stage is going to make the case that corporate climate action is business value creation. And so let's go to our esteemed panelists. Ray, let's start by painting the bigger picture. How fast are climate and ESG indexes growing within investment portfolios? And what does that say about the ROI? And I think we've got a nice little slide to help Ray paint the picture. Maybe we can throw that one up while he gets started.
So at MSCI, our job is fairly straightforward. We help investors build better and more resilient portfolios with better data to back it up. We're best known for our indexes, and also some of you may know us as a large sustainability ratings and climate data provider. Essentially, we develop novel solutions to complex investment challenges. Going back to the indexes here, we have about 17 trillion in assets benchmarked to our MSCI indexes. Within that, approximately 1.13 trillion is benchmarked to sustainability and climate. For reference, that's about the same as infrastructure as an asset class globally. So you can see the trajectory right behind me. On the right-hand side, we've grown in the past 3 years at almost 20% in sustainability and climate indexed AUM. And that's been primarily driven by climate and climate indexes. 3 years ago, climate represented approximately 10% of sustainability and climate AUM. Today, it sits at about a third. So it gives you a reference as to how quickly the climate-oriented scape is growing. The shift tells you a lot about investor behavior. It's no longer about screening things out, more so about trying to understand, as it relates to the energy transition, who is better or worse positioned as we face new disruption across segments, across industries. Indexes have become common knowledge for capital markets, yet corporates now understand that getting into more indexes provides more visibility, more credibility, and really anchors themselves towards where flows are going.
Thanks so much for kicking us off, Ray. Let's continue to pull that thread, thinking of organizations, corporations, finding that value, getting into indexes. Ariane, you come from a unique perspective at TMX. Why should or why are corporations treating climate performance and reporting as a business opportunity and not just as a compliance exercise?
Hello, it's on. Well, before I talk about the business opportunity, I did want to touch on the just compliance piece. We do have to recognize that there is some limited amount of mandatory disclosure still applicable in Canada, and that does tend to have an impact beyond the boundaries of an organization. We have our banks, pension plans, insurers. We have some larger corporations that operate in other markets that are also subject to mandates for climate disclosures. And those dynamics do tend to put pressures on borrowers, investees, as well as supply chain partners to share their own climate data. So it does kind of tend to have a trickle-down effect into the broader economy. So ESG detractors, I'm sorry, they are very loud. Indeed, but we also hear investors, we know that climate risk is still a material risk for institutional investors especially. And we know that they continue to integrate those concerns and those issues in their investment strategies. So for companies really to issue disclosures on this topic is their opportunity to tell their own story in the way that they want it to be told. Not necessarily entirely relying on third-party ratings or internal modelings that investors would have to otherwise use. So not doing that would be a missed opportunity. We also know that through a lot of the companies that have set targets for emissions reductions, we also see requests for climate data, as well as some conditions in contracts for target setting coming through procurement processes. So really for corporations, it's to define what that business opportunity really is. It's a bit of a self-exploration, looking at how climate is is financially material in your strategic context. Because in those cases where you're going to seek to expand outside of Canada, especially at this point, so into other markets, or you're seeking to tap into expanded pools of capital providers or access contracts with large corporations, climate disclosures really is a business enabler.
Fantastic, thank you. So thinking about those organizations that see that business opportunity, and I know we've heard in the last couple of panels how Canada loves to think about itself in the global context. Abdullah, you've had the chance to look at the behavior of corporations of all shapes and sizes across industries and around the world. So from your perspective, which industries are really leading the charge in terms of driving corporate climate action by asking for those climate disclosures from their suppliers?
Yeah, I think what I've seen in the whole world is like very drastically different to what we see here in Canada, and I think it's only a matter of time before businesses who are aligning themselves with what's trending in global markets is going to find themselves getting a lot bigger, and the businesses who are slow to catch up are going to be fighting for scraps. But in my experience so far, I deal with a lot of physical goods industries, so these industries are like retail and anything product focused, if you can think of. In the last 50 years, all of the manufacturing has been exported to Asia and other parts of the world. And what I'm seeing right now is that because it is the biggest portion of a company's climate footprint or carbon footprint, that is the area where companies are pushing to reduce because that will have the most tangible results. While, like Ray was talking about, the $1.1 trillion in indexes. So imagine all the companies who represent that index. They have hundreds of thousands of suppliers and manufacturers all over the world. So there is this top-down pressure in RFPs, in bid processes, in becoming preferred suppliers that is shifting what companies do business with what companies. So a lot of the B2B producers, I would say, are, if they're not availing carbon as a easy way to stand out, then they're falling behind. And especially as Canadian producers look for new markets that are not US, Europe is a lot farther ahead in terms of compliance requirements. So if you can equip yourself proactively to provide this information to your customers, and you can remember that customer is king, and you can keep your political affiliations to the side, then this is a super easy way to stand out and get your one big customer that'll help you get many more because you had that data at hand.
So speaking of big customers and continuing on that line, how are some of those market leaders like the Walmarts, the Amazons of the world, how are they using that kind of data to make procurement strategic decisions with respect to their supply chains?
Yeah, so if I hadn't seen it for myself, I wouldn't believe this information. It's that kind of a tidbit, so I hope that everyone else can take that away and start understanding how business is being done with carbon data. So a couple ways that I've personally seen it is that if, taking Amazon and Walmart as an example, they have a large footprint all over the world. They are using all of this carbon data, water data, waste data to create a new form of supplier benchmarking, which then essentially informs their procurement team who is going to be a supplier for me for the next 5 years, the next 10 years, the next 15 years. And the companies that are performing well in those metrics, as they're aligned with those companies' goals, they are seeing increase of revenue. So they're getting a lot more orders, a lot more volume of orders. And then there's a part in Europe that I actually just saw last week for the first time, which was somebody just sent me their contract and said that there's a clause that says, if you don't give me the carbon footprint data at an X amount of frequency, this contract is null and void. So if you can keep that in mind while you're thinking about carbon, while you're thinking about water impact and other environmental impacts, think about how your customers are going to use this data, because one way or another, you have a lot of business riding on it.
That's wonderful to see those incentives being market driven. Ray, let's come back to the investor perspective. Are investors actually rewarding companies with stronger climate performance?
Thanks, Elizabeth. So as you mentioned at the start, at MSCI, we work with the largest responsible investors across the globe. In particular, Canada has some of the most sophisticated. So from my vantage point, certainly yes. It's showing up in a few clear ways. So one is capital allocation. As I mentioned, there's over $1 trillion benchmarked to sustainability and climate indexes. And as a result, companies that manage climate risks effectively get a bigger share of investor portfolios. Second is climate performance. So through extensive research that we've done at MSCI, we see that firms with lower transition exposure have outperformed their high-emitting peers. In addition to that, they carry lower credit risk. The market's learning to tell the difference between emissions that really matter, i.e. financially material, and those that don't, and is also starting to refine how they price those distinctions in. Third is valuation. Companies that manage climate issues well tend to run better businesses. Steadier revenues, stronger asset efficiency, and lower financing costs. That comes down to governance, discipline, and predictability. Investors value that consistency. You can see it play out in real terms. For example, we did a case study on Mizuho Financial. Mizuho, over the past 2 years, has done a great job taking concrete steps to rebalance their balance sheet, cutting exposure to carbon-intensive lending, scaling investments in renewable infrastructure, and improving climate governance from the top down. These actions weren't just symbolic. They led to an upward reweighting across MSCI climate indexes, and as a result, they attracted roughly 80 million in new passive inflows as investors responded to their strong transition profile. It's a clear case of capital following transition credibility, proof that concrete action and disclosure can directly shape investor demand. There's an interesting loop here that Abdullah and I have been talking about. Better disclosure and strategy drive stronger index positioning, which draws capital, lowers funding costs, and boosts valuation.
Yeah, and 80 million, that feels like a reward. I like that. I would take that. Ariane, let's continue down that line of questioning. In your view, how can Canadian finance play a stronger role in incentivizing climate action and adoption from a market perspective?
Well, in my view, it's about really connecting the dots between emissions performance and disclosures and that improved access to capital. So the work that Arbor and MSCI and the likes are doing is critically important, obviously. With the continued attacks on poor Elizabeth here in ESG,
I won't take it
we do know, and I've said it earlier, investors are a little bit more quiet about how they might reward climate action. And when we combine that with the general refocus and emphasis that is very strong on competitiveness, we seem to hear less and less about how important climate change truly is for investors. We don't really hear it as much in earnings calls, especially, and more importantly, on one-on-one investor engagement calls. So it's not unreasonable with that trend for executives to think that perhaps climate is maybe no longer or less of a driver of investment decisions. And this could lead to the unfortunate consequence of companies deprioritizing climate action to instead focus on other competing business priorities. So for me, it's about continuing that engagement. And I know lots of you here today are doing that, but it's not letting your foot off the gas and continuing to do it regularly. It's important to raise these topics with corporation so that we don't lose the positive momentum on disclosures that we've gained, even here in Canada. Despite, again, the negative headlines, we have lots of recent disclosure studies that actually show steady progress on climate disclosures with top Canadian issuers, as well as even more SBTi target validation. So some things to celebrate. So I think continuing to demonstrate that connection between climate performance and disclosure and better and more affordable access to capital is especially important. And that'll be critical, the affordable part, for that to penetrate the small, medium enterprise ecosystem as well, so that they can feel like it's worth it for them to invest in disclosures and the whole structure that is required to do that if they know they can access capital more easily. Thank you.
Yeah, thanks for that. I mean, it is hard not to feel a little bit pessimistic at times, and that showed up a little bit in the audience in our engagement question that we started out with, and it's hard to ignore what we're reading in the headlines to the south, erratic behavior, the death of ESG. Again, I won't take it personally. Corporations and financial institutions seeming to either publicly pull back from targets or perhaps not having the same focus. So Ray, I want to come back to you. Like, why should we believe in this ROI for sustainability? What's happening behind the headlines?
Your guess is as good as mine.
That's it. That's the answer. No.
I mean, look, it's easy to get distracted by the headlines, but there are tidbits that tell a very different story. So, for example, if you had invested in the energy transition at the start of this year, you would have beaten gold as well as the S&P 500. So energy transition investments have been among the best performing trades this year. And that's investors responding to economics, not politics. As the world needs more power, we need electricity for data centers, we need it for manufacturing, and renewables are still the fastest way to add to the grid. We're also seeing momentum build in the real economy. So luckily for all of us, interest rates are going down, but that's fueling new, very capital-intensive green projects around the globe, and global investors are scaling quickly. Just last month, a great example was Brookfield. They launched a $20 billion clean energy transition fund, which is the largest fund of its kind anywhere in the world. They're going to be deploying capital across renewable generation, storage, and grid infrastructure, showing how sustainability has become more of a mainstream asset class opportunity rather than a niche theme. That kind of capital formation underscores where sustainability is still viewed as a growth opportunity and not a constraint. So I think, Aniket Shah said it best at Jefferies. We're now at a point where markets and the real economy are moving together. And investors aren't chasing ideology, they're focused on productivity and competitiveness.
Awesome. Thanks for not leaving at that. Your guess is as good as mine. No, these are real projects with real returns, regardless of the politics at the surface. And so, Abdullah, let's continue that thread. Again, given what's happening in the U.S., there is a reality that Canada is faced with some real challenges from an investment and market access standpoint. Can you share some examples where companies are using climate performance and disclosures to win new business or access new markets, say in the EU or elsewhere?
Yeah, we're seeing a pretty interesting shift in business development with all this market shift movement and supply chain turmoil and tariff nightmare, whatever we want to call this thing. What I'm seeing is actually that the first wave of companies looking to do carbon disclosures or climate disclosures were doing it because there was some law that they were afraid of that was going to hurt their company profile. But once they did it for that one customer that made them go through that painful exercise, I kind of relate that to your first workout and you're all stiff after and you're like, oh, I can't move and I don't see results that, I'm proud of.
That's every workout.
But then what I'm seeing right now is that as soon as it clicked in the executive's mind that, hey, if one company is asking for this data, maybe there's 10 more companies who could use this data to make their procurement decisions. And what I've seen is that if somebody was able to either go get that first Amazon, or they have just lost that first Amazon because of the US and Canada, geopolitical stuff, they have actually now made it part of their sales and marketing materials instead of having to rely it in some corner office that sustainability team hangs out in. So yeah, I think if you can use it within procurement, within sales, within marketing, you can go create 10 more new customers that are going to be here for the next many years to come.
So we're getting very close to wrapping up this session, and I promised we'd be on time, and I see things are happening.
Gary's
Things are happening. So maybe I'll wrap this one up. You're asking me to hold a lot of things.
I can hold it.
I think I can manage. We talked at the start about having come full circle. The corporate easy for you to say, The corporate sustainability movement did not start with a desire for increased reporting requirements. It started with the notion of value creation, long-term returns, and impact. Fast forward to today, despite unprecedented economic and political uncertainty, some of us are about to head across the street to the next door to the downstairs to the Toronto Stock Exchange to ring the bell and close the market for climate. That's something that early pioneers of corporate sustainability would never have imagined. So I think we're going to have a toast, but maybe I'll just invite each of our panelists, wrapping it up, very brief, 30 seconds or less. What is one message that you'd love to leave our audience with when it comes to the return on sustainability? Abdullah, we'll start with you.
Yeah, I think any initiative that your company's planning on doing, I promise carbon would be a lot cheaper and give you a lot more return. And it's very easy to stand out in the market today. But if you wait another couple of years, then it's going to get only harder and harder, and you're going to be falling behind the curve. So start today.
Start today. Fantastic. Ray, what's one message you'd leave with us?
So climate's clearly going to be a major determinant of portfolios across the globe. There's no transformation in the history of mankind that hasn't been led by capital. There's going to be a reallocation of assets and a repricing of those same assets. As a result, there's going to be a lot of winners and a lot of losers. And they're all in the portfolios of our clients today. So the key question for investors is, how do they discern those risks? How do they understand who those winners and losers are and start to adjust their portfolios to reflect that? I think that's the real ROI of the story today.
And Ariane?
Well, there's one way to shut a French woman up, is to offer her a glass of wine. But the other thing I want to say is just sustainability is about resilience. So in this scary phase, just use it as recalibration period to anchor sustainability in your business strategy. And that will help make the ROI self-evident. Thank you, everyone.
Bravo.
Glass half full, everybody. Thanks, Gary. Appreciate it.